Okay, market heroes, we're back. We're talking about strategies now. And the first strategy that we're going to talk about, which is really like the staple of what we're trying to accomplish here, and it's just another step on what we've been talking about up to this date with all kind of the high level principles you need to understand if you want to really be a successful investor and trader. But now that you've done that, you're really on your way to becoming a market hero. So the first strategy that we're going to talk about is called a strangle. No, I'm not strangling you, but we kind of are strangling the market here. So we want to talk about what a strangle is and exactly when to do it, right? Pretty simple. So at a basic level, a strangle involves selling an out of the money call and an out of the money put at the same time in the same trade. If you don't know what out of the money is, you need to go back to that lesson and figure out what it is. But if you do know, we can move forward. So if I were to go and show you exactly what that is, let's go to SPY. And again, we do SPY because of the liquidity that is in there. And let's say we want to go to this October monthly expiration. Now, all it is, let me just get rid of some of this stuff real quick here. Out, 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 out. All we're doing again, like we mentioned, is selling an out of the money call and out of the money put at the same time. So what we're going to do is we're just going to left click to sell, right? So we're selling a call, and at the same time, we're just going to sell a put. As you can see, this thing out of here. As you can see, come on, drag. It's not cooperating. Okay, that's fine. As you can see here, that is a strangle, right? All it is selling an out of the money put, out of the money call at the exact same time, right? And we make money if prices fall between our short strikes at expiration or between, right? Again, because if we're selling an out of the money call, in this case the 252 call, we're hoping that this call expires out of the money or the price of the stock is below the price of the strike. And at the same time, if we're selling this put, we're also hoping that this put expires out of the money and the stock is above. So we're looking for above 233 and below 252. Right? So that's all a strangle is, nothing crazy, right? And for that, we collect a credit which right? So you can see here we're collecting $1.66 in credit. So actually, we're not going to be a loser on this trade until $1.66 beyond both strikes. So 252 plus $1.66 equals, to the upside, we will not be a loser until we're over 253.66. And on the downside, we're not going to be a loser until it's below 231.34. And if we want to go ahead and execute this strategy, the platform is going to show us that, so we can see our break evens are not just the strikes that we're actually executing the trade on, right? It's not 252, it's a little bit higher, and it's not 233, it's a little bit lower. Again, because when you sell an option, we're collecting the credit for doing so. We're collecting the price that someone is paying us for it. Again, why do we sell these options? We sell options because options are priced off the expected move, and the expected move is overstated. So we make money on this strategy if prices fall between our short strikes. Remember, we're selling an out of the money put. We want the price to be above that put. And we're selling an out of the money call. We want the price to be below that call, right? So we want it in between there, right? Or if volatility decreases over time, remember, if volatility or the expected move decreases over time, the value of those options also decreases. And since we're selling them, we want that to happen. Right? So you're going to hear a lot about this in the future. This is like the staple for what we're doing here. So the most basic strangle that we talk about and that I will talk about from this point on with you, and it will absolutely get you to where you want to be in the stock market, and it'll absolutely get you to where you want to be in terms of becoming a market hero, excuse me, is the one standard deviation strangle. If you don't know what a standard deviation is, you got to go back to whatever it is, module 1 or 2, where we talk about market randomness and exactly what this is right here. This is a normal distribution curve, right? And the expected move is one standard deviation. Now, we expect prices to fall in between the expected move, or one standard deviation, 68.2% of the time. right? So that means we expect it to finish outside to the call side about 16% and outside to the put side about 16%, right? So the standard deviation or the expected move strangle would be to sell the option that gives us a 16% chance of being wrong, right? So that would just be the 16 call. And at the same time, selling the put that gives us a 16% chance of being wrong, that's a 16 put, right? So we're doing it at the same time. We already had these strikes. Right here, this is the one standard deviation put. So what this says is, today is September 5th, 2017. On October 20th, 2017, that's 45 days from now, the expected move in SPY is up to 252 or down to 233. And again, we've done a lot of studies that implied volatility. Implied volatility is what options are priced off of. It's the expected move. Historically, that's been very overstated to the actual move, right? So this is just placing a bet that the expected move is going to overstate the actual move. And the way we're profiting on that is the value of these options we believe will be lower when they expire because, again, we're selling something that is overstated, right? So that's all we're doing. So again, this is just your basic one standard deviation strangle. This is your expected move. So since we know that options are overstated and that options are priced off their expected move, we would expect this to be a profitable strategy, right? So what we're going to do at this point on is we're going to talk about some studies, right? Now again, none of these studies are going to be cherry picked. This first study is from 2003 to present. That's 14 and a half years of data. Right, and what we did was every single day in SPY, and again, the reason we do it in SPY is number one, the data is really easily available, and number two is the liquidity is second to none. It's the absolute best, most liquid product in the world. So in SPY, which is the S&P 500 Index ETF, every single day, that's 3,600 plus occurrences. That's a big sample size. Every single day, we sold the one standard deviation strangle, right? And that's all it is just a bet that the expected move is going to be greater than the actual move. We know that's true, so this should be a profitable strategy, right? Where we sold a 16 delta call and a 16 delta put at the same time. And we did this in the monthly expiration cycles that are closest to 50 days from expiration and held. And what we did was we held the trade until expiration. So we put it on, we didn't do anything, and we just calculated the P&L and if we were right or wrong when the trade expired. So while most of you know at this point, if you didn't skip ahead, well, most of you know that this is going to be a profitable strategy for us. We don't really know how profitable it actually can be, right? So again, conventional wisdom is going to tell us that we should be right 68% of the time. Why should we be right 68% of the time? Well, because the expected move is supposed to fall within one standard deviation 68.2% of the time. And this is just a bet. All this is a bet that on the expected move. So we expect to be right 68% of the time. And again, because conventional wisdom tells us, guys, conventional wisdom tells us that it's a zero-sum game. One guy makes $1, one guy loses $1, one lady makes $1, one lady loses $1, that we should make $0. So doing this every single day, 14 and a half years, that includes bull market, bear market, and a bull market again. How did we do? Well, look at the left column, right? The expected, again, we expected to be right 68% of the time. It turned out we were right 81% of the time. Now, why is that? Again, that's just a clear indication. It's just another indication of how the expected move overstates the actual move. And options are priced off the expected move. So options are overstated in their price. Instead of making $0 per trade, we made $74.50 per trade. We were in this trade for about 50 days, and the average P&L per day was $1.49. So this is a big deal, guys. You know, you want to get on your way to being a market hero. This is a big deal because you have a clear edge here. A lot of people come to this course and say, Stephen, I don't feel like I can compete because the banks, the high frequency traders, you know, the hedge funds, they know so much more than I do. Wrong. Now you know that here's one strategy that is consistently profitable over 14 and a half years. That's right. Bull market and bear market. You're supposed to be right 68% of the time. Now you're right 81% of the time. Not bad. Let's take it a step further here. So now we did same years, right? So 14 and a half plus years of data, depending on when you're watching this, right? So in SPY again, every single day we did a few things, right? So the first thing we did was we sold the one standard deviation expected move strangle, selling the 16 delta call and the 16 delta put, right? So we did a few things. The first thing we did was we did the same thing as last time, where we just let it expire. Remember, in this study, we're putting the trade on, we're doing nothing, right? But one of the big things for us is, as you know, if you haven't skipped ahead, is managing our trades, right? And conventional wisdom will say you need to cut your losses and let your winners run, right? So that's what conventional wisdom would say. Our argument is that doesn't really work for us. What I'd rather do is I'd rather manage my winners. So what this study is trying to show, if that's true or not. So what we did here was the first part of the study, we did the same thing we did last time where we put the trade on, we did nothing. Turned out it's wildly profitable. So what we want to do is we want to see if we can make more money by letting our losers run and cutting our winners, right? Managing our winners. So what we did was we purchased back the strangle for half of the credit we received or let it expire if nothing happened. So if we go back to our example, we're selling this strangle for $1.66. In this case, if the value of the call and put were 83 cents at any point in this strategy or in this trade, we would just buy it back. We'd buy it back for half of the credit we received. If it never got to 83 or below, we would just let it expire, right? So that's what we did. So let's see how we did. Well, let's go from left to right. So first of all, again, it's critical to talk about what's expected here because we do have an edge. This is where your edge is. The expected move is greater than the actual move. Instead of being right 68% of the time for $0, if we just hold it to expiration, we're right 81% of the time for $74.50. We make about $1.49 per day. It's pretty good, especially since this is not a very capital intensive trade if you have a margin account. But if we took it a step further and we said, okay, we want to manage our winners. If you buy back for 50% of the credit received, you're not right 68% of the time. You're not even right 81% of the time. You're right 91% of the time. You do make less overall. So instead of making $74.50, you make $48.75. However, you're in the trade for half of the time, and your average P&L goes up about 33% to $1.95. That's pretty damn good. That's pretty damn good. So again, guys, we started out by doing something that you're supposed to make $0 because it's a zero-sum game, right? You're supposed to be right 68% of the time because in a normal distribution curve setting, prices will fall within their expected move 68% of the time. Totally makes sense. Now we've taken it to being right 91% of the time, right? 91% of the time and $1.95 per day. Not bad, but we're not done yet. You know we like to take it a step further, guys. This is why I love teaching this stuff so much because it's so amazing because you guys don't even realize how much of an edge you have. Hedge funds cannot do this. They're too big. But unless you have over about $250 million, you can do these strategies so you're blue in the face. That's what's so cool about this. Okay, so we took it a step further. Same days, every single day, we sold the one standard deviation strangle, right? It's just the expected move strangle where we sell an out of the money call and an out of the money put, right? Now, we did a couple things here. We did the same thing as last time. So, number one, we let it expire on its own. Number two, we bought it back for 50% of the credit we received. Now, this time, what we wanted to do is we know that when the expected move is greater than average, it overstates itself even more than normal, right? It always overstates itself over time. But when the expected move is greater than average, it, I guess, extra overstates itself is the way to think about it. So what we wanted to do is we wanted to see if we were able to make more money when we just executed these strategies when volatility or the expected move was above its average, right? So again, we're looking at a couple things. Number one, we're looking at just placing the trade every single day, letting it expire. Number two, placing the trade every single day and buying it back at 50% of the max credit we received. Then we want to take both of those strategies and just execute them when volatility is greater than average or the expected move is greater than average, right? That's it. That's all we're doing. Again, this is over 14,000 occurrences. That's a big enough sample size where this data is dead ass accurate. Here we go. So again, from left to right, we're expected to be right 68% of the time because in a normal distribution curve of random occurrences, it says prices will fall within their expected move 68% of the time. However, if you do this trade every single day, you're right 81% of the time, and you end up making about $1.49 per day. Not bad. However, when you do this trade every single day and you hold it to expiration, you're right 82% of the time for about $2.57 per day. So almost a 50% improvement on just doing it every single day. So you get about a 50% improvement on that strategy just doing it at the right time. And again, you guys know exactly when that is. That's pretty good. But now let's take it even a step further. Right, when we buy it back at 50% of max profit, we're right 91% of the time for $1.95 per day, but we're only in the trade 25 days, so half the time. Again, redeployment of capital is a big deal, guys, because the more of these occurrences you get, the more money you'll make. But the ultimate strategy is if you do it when the expected move is greater than average or volatility is high, and you buy back for half the credit you received, you're right 93% of the time for $3.43 per day. That is almost 3 times better than just doing the strategy every single day and holding until expiration and not doing anything. So when you manage your winners, let your losers run, and just execute this strategy at the right time, you're 3 times more profitable. Remember, guys, we just took a strategy, and girls, where you're supposed to be right 68% of the time. Now you're right 93% of the time. You're supposed to make $0 per day. Now you make $3.43 today. So this is the edge, guys. So remember, you want to do, so you can do this strategy clearly whenever. It is most advantageous to you. 2 things here. Number 1, executing this strategy or selling a strangle, and again, this is the 1 standard deviation strangle, when volatility is above its average. Right? And you guys know exactly how to do that. We have lessons on that. And number 2 is, if you do it at that time and buy it back at 50% of the max credit you received, now you're right 93% of the time for $3.43 a day. So this is really, really huge, guys. We have a lot more for strangles to come here in just a few moments. So I'll see you on the next video.